Everybody has an opinion as to whether the economy is going to boom or crash in the next 12 months, and BlackRock just gave their 2 cents. According to BlackRock, the United States economy has less than a 3% chance of entering a recession in the next year. Now, the reason that might be a little bit of a surprise is because back in December of 2022, BlackRock said that the United States has a 40% chance of entering a recession. And then in 2023, BlackRock published this piece, Navigating the Stock Market at a Time of Recession. You know what? Let me just read you the first line of this 2023 article. All signs are pointing to a recession in the United States in the second half of 2023, with the impact of higher interest rates starting to be felt in the real economy. Now, of course, nobody can predict what's going to happen in the economy tomorrow, let alone next year. But what I want to do in this video is I want to go over the 3 reasons why BlackRock says that the United States is most likely going to avoid a recession over the next year. But I also want to go over the risks that they talked about in this report as well. So the 3 reasons that BlackRock says that the United States is probably going to avoid a recession is because of, number 1, there's been a tech and AI especially boom in the stock market, keeping the equity market afloat. Number 2 is labor participation and immigration in the United States boosting the job market. And number 3 is momentum in the economy to push us through the next 12 months. Now, of course, BlackRock also did say that there are risks in the economy. These risks include, number 1 is higher than expected inflation. Number 2 is higher geopolitical risks. And number 3 are higher for longer interest rates. So let me start by going over why BlackRock says that the United States has less than a 5% probability of entering a recession. Then I'll go over the risks. And I also want to remind you that on May 21st at 8 p.m., which is just around the corner, I'm hosting a live, free, and virtual stock market investing workshop. So if you have money in a 401k, an IRA, or if you're investing your money in the stock market yourself, you do not want to miss out on this workshop, because I'm going to be going over a lot of my strategies on how I analyze stocks, how I look for good funds to invest in, how you can lower your fees the right way. So if you'd like to join me, it's completely free, and I got the link to this workshop to register down in the description below. So let me start by talking about number 1, how tech and AI have been helping the stock market boom. With stalling inflation progress, equities largely continue to climb as solid earnings and artificial intelligence excitement overshadowed renewed concerns. That means although we've been seeing these concerns in the economy with inflation, you have this artificial intelligence boom, which has been helping the stock market grow. That means even though inflation has been rising, not falling in 2024, the stock market has been growing, partially due to the artificial intelligence boom. Now, the reason why artificial intelligence from an economic perspective is so interesting is because on one hand, artificial intelligence is leading to some job losses. Companies are laying off some of their employees and replacing them with robots or artificial intelligence. But at the exact same time, you're also seeing a boom in hiring on the artificial intelligence side of things, because companies want to hire more people who understand artificial intelligence. Now, the reason why this matters is because our economy runs on spending. You've heard me talk about this a million times now, where when you go to Chipotle and you spend money, Chipotle makes more money. That gives them money to hire more employees. That gives them money to pay their employees more money, and that gives them money to grow. But if you go into Chipotle, you have no money, and then you walk out, that's not good for the Chipotle company, because they don't have money to pay their employees. Well, the place where a lot of spending has been happening now isn't the same discretionary spending that we've been seeing happen before, because unfortunately a lot of Americans are now starting to run out of money, and you're seeing more and more people starting to cut back on their spending. But you're seeing a spending boom on the artificial intelligence side of things, because companies are now trying to compete against each other in this artificial intelligence race. And this is creating a boom, not just in the stock market, but a little bit in the economy with these artificial intelligence jobs. And this naturally has been benefiting AI stocks throughout 2024. Which brings us to point number 2, which is the job market, more particularly what's going on with labor participation and immigration in the United States. Increased labor participation and immigration are helping to restore better balance in our job market. Now, you might be wondering, what the heck does better balance in the job market mean? Because on one hand, we hear news about how we have such low unemployment, but at the same time, we also hear news about how people are struggling to find a job that's paying enough, and also people are still struggling to find jobs because they can't find a job that meets their qualifications. Well, take a look at this chart. What this chart shows us is obviously there was a boom in jobs and hiring recently, but today there are still more non-tech jobs available than there were pre-pandemic. So this is what BlackRock is saying, is it's not just the tech industry that's having this boom. We're seeing this growth pretty much everywhere. And so now, because we have these more jobs available, we're also able to fill these jobs thanks to immigration. Take a look. In 2023, the United States population grew by around 1.75 million people. At the same time in 2023, there were about 878,000 legal immigrants that came into the United States. Obviously, we can't track the illegal immigrants as well, but we're talking about the legal immigrants, people that came in legally into the United States, which meant about half of the population growth in the United States came directly from this immigration. Now you might be saying, but Jaspreet, if we're seeing this increase in population, this might be why it's so hard for people to find a job. We'll take a look at this as well. In 2023, there were 2.7 million jobs created in the United States, according to the reported data. What that tells us is if we take a look at this reported population growth, that means that there's a job for every new person that's entering the country, and that also creates jobs for people that didn't have a job before. So based off of these numbers, this looks like a healthy number, which is why BlackRock is saying our job market is still healthy, because we still have a healthy number of legal immigrants coming into the country. We're still seeing some population growth, and we're still seeing job growth, which means if we continue to see this growth in population, we have more and more people that need a job, which means we can continue to boost the workplace, which means we can continue to boost the economy. And this is one of the reasons why BlackRock is saying that the United States has less than a 3% chance of entering a recession in the next 12 months. And the third positive point that BlackRock pointed out about the economy is the momentum of the economy. But interestingly, when they started this point, what they said is essentially that there are risks to the economy because of the momentum. However, they don't see it as a concern. Take a look. The length of momentum outperformance could be a cause for concern as it approaches that of historical periods. Meaning we've been seeing this very strong momentum in our economy, which could be a concern that our economy is overheating. But this is where what BlackRock says is because it's supported by other things like this job growth and then also the growth in the stock market, that they're not too worried about it. Take a look. Our analysis suggests that the positive exposure of momentum to current macroeconomic trends and the breadth of stocks driving momentum returns are keeping those risks relatively contained. So what they're saying is, although our economy has had all this momentum, and although it's been happening for a long time, normally that might be a cause for concern, but because of the strength in the job market and the stock market, that is not that big of a deal. Which now brings us to the second part of this video that I want you to understand is, well, although all these things are good, and although BlackRock says that all these things contribute to less than a 5% chance of a recession in the next year, they still say that there are some potential risks in the economy. What are those risks? Well, number one is high inflation. Number two is higher geopolitical risks. And number three are higher for longer interest rates. Macroeconomic uncertainty could be here to stay as inflation has pushed back on rate cut expectations and geopolitical risks have increased. Now, these are things that my team in Market Briefs has been talking about a lot, but the inflation numbers that we have seen so far in 2024 have all been higher than expected, which means that inflation has been coming in hotter in 2024, not cooling down. What that means is for the average person, it's more expensive today than it was last year, and they're not seeing their wage growth keep up with the higher cost of living. So you got to go to the grocery store and pay more money relative to your salary. You got to pay more money on your rent relative to your salary. You got to pay more money for your car relative to your salary. And all these things, man, people have less money to spend. In addition to that, we have the higher geopolitical risks. Now, obviously, we've been seeing this happen for a number of months and years now because it all started between Russia and Ukraine. Now you're seeing it in the Middle East as well. All these things can contribute to political and economic risks in the economy. I mean, just take a look at what's been happening with oil prices recently. And then, of course, we have the higher for longer interest rates, which tie into all of this, because when we see this higher inflation, it gives the Federal Reserve Bank less fuel to start cutting interest rates. And the reason why that's a concern is because we have a lot of companies and a lot of commercial landlords that are sitting on huge piles of debt that are at these very low interest rates that are now getting ready to readjust because corporations and commercial landlords don't get these 30-year fixed rate mortgages. They take 3, 5, 7, or maybe 8 or 9 year mortgages, but primarily in that 3 to 7 year mortgages. So everybody that was taking out these millions, billions of dollars of loans back in 2020 and 2021 are now starting to see this huge debt pile start to readjust. Now you can see why that's a problem, because when you borrow this money at 2 or 3% and then it readjusts to 7 or 8%, that means you're going to pay a lot more money in your debt costs. And unless you're making the big bucks to service these big debt costs, you're going to be in big trouble. And that's why these higher interest rates have been contributing to things like layoffs, even bankruptcies in 2024. And this is where you want to pay attention to what this is going to do, because if inflation continues to come in hot, then interest rates will probably stay higher for longer. And if interest rates stay higher for longer, that could put more pressure on landlords and businesses. And inflation, if that comes in higher than expected for longer than expected, which it already is longer than expected, but let's just assume it stays even longer, well, that means that for the average person, it is harder to pay for your groceries, it's harder to buy a car, it's harder to pay for your rent, it's harder to buy a vacation, it's harder to save money, it's harder to invest your money. You can kind of see the issue here. So this is where you want to pay attention to the issues. You also want to pay attention to the good things that is happening in the economy. But the most important thing that I want you to get out of all of this and out of all my videos is this. It doesn't matter what's happening in the economy. There are ways to win no matter what's happening in the economy. Now, yes, it pays dividends to understand what's happening, that we can take advantage of opportunities. But the key, did I say that already? The key is you got to be financially educated, you got to be prepared. Financially educated means you got to be able to find the opportunities, you have to know how to invest. That means it pays to invest in your own financial education. And number two is you got to be prepared. You can see the best investment opportunity in the world, but if you have no money to go out and take advantage of the investment opportunity, it doesn't do you any good, which means you got to start living below your means. And I know that's very hard during a time of high inflation, but guess what? It is going to be easier now than it's going to be next year, the year after that, and the year after that. So better for you to start preparing today. Put some money aside, not just to protect you, but then also to be able to capitalize on opportunities that might come your way and build that financial education so you can start investing your money and take advantage of the way that our economic system works. McDonald's says that low-income consumers are starting to crack. Normally, when you start facing tough times in the economy, the discount retailers are the ones that start to see the biggest boom because people are looking for cheaper alternatives. But that's not what we're seeing happen right now. Even if you take a look at what's happening with dollar stores are struggling instead of growing, and you're seeing them downsize.